Now, India's presence in the global market capitalization has recently achieved a noteworthy milestone, reaching a record high of 3.8%. Now, it's worth noting that this figure is above India's long-term average share in the global market capitalization, which stands at 2.6%. Now, this accomplishment solidifies India's standing as the fifth largest equity market globally, trailing closely behind Hong Kong. Now, what's particularly striking is the substantial addition that India has made to its market capitalization in 2023 alone, surpassing $900 billion right behind the US. Now, to put things into perspective, this figure is equivalent to the entire market capitalization of nations like Brazil, Sweden, and the Netherlands. Now, breaking down the global contributors to the market capitalization, the US takes the lead with a substantial 45.6% share, followed by China, which enjoys an 8.6% share, Japan, which follows a 5.6% share, and Hong Kong, which has a 4.3% share. Now, this data underscores India's growing influence and prominence in the global financial landscape. Now, a key driver behind India's robust market performance is the sustained rally in the domestic equity markets. Now, the benchmark indices have surged, reflecting a prevailing optimism regarding the country's long-term growth prospects. Furthermore, another noteworthy development underscores the active participation of India's middle-class investors in the equity market rally. Now, the assets under management, or the AUM, of the Indian mutual fund industry have experienced a remarkable surge. Now, over the past 1 year, the industry has undergone significant transformations, showcasing resilience, adaptability, and an increasing impact on the retail investors. Now, the AUM has witnessed an impressive 20% year-on-year growth, surging from 40.5 lakh crores in the month of November 2022 to 48.75 lakh crore rupees in the month of November 2023. Now, this not only reflects the industry's ability to weather challenges, but also highlights its robust growth trajectory. Now, looking ahead, the Indian mutual fund industry is poised to maintain its growth momentum in 2024. Now, this optimistic outlook is supported by the strong macroeconomic fundamentals of the Indian economy and a resilient trend in the earnings growth. Now, another important development is the narrowing of the current account deficit to 1% of the GDP in the second quarter of FY24, which is a significant improvement from the 3.8% of GDP recorded in the corresponding period of the previous financial year. Now, the notable reduction in the current account deficit for this financial year's second quarter can be attributed to a combination of factors. A lower merchandise trade deficit played a crucial role, along with the commendable growth in services exports. India's overall export, however, experienced a slight declining by 2.83% to $33.9 billion in November 2023 when compared to $34.89 billion worth of exports in November 2022. Now, import figures also saw a decline, with imports falling to $54.48 billion in the month of November 2023, down from $56.95 billion recorded in November 2022. Now, this resulted in a trade deficit of $20.58 billion in November 2023. Now, the current account balance, whether in deficit or surplus, serves as a crucial indicator of an economy's external health. Now, given that India is a net importer, the occurrence of current account deficit is expected and is normal as well. Now, the reduction of India's current account deficit to 1% of the GDP in the second quarter of this fiscal year compared to 3.8% a year ago is an extremely positive development. This improvement in the current account balance adds a layer of stability and resilience to India's economic standing in the face of global economic challenges. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.